It's quite interesting actually, because I was on this show a couple of weeks ago and I said we're gonna get maybe 3 rate hikes, and I think the response from you guys was like, what are you saying? Because JP Morgan at the time was asking for 7. Now, I still think there might be, central banks, they move really slowly, right? So I still think they might increase interest rates a bit and still try to rein things in. But if you look at the S&P 500, from its high to its low, it just declined with 15%, which is not a lot. If you look back at what happened under COVID-19, we had a slide of 36%. Now I'm not saying we're gonna have a 36% slide, but I would wait for a bigger discount than just 15%. Like right now, for example, we're down at 10, so maybe let it slide at least 20, maybe 25% before taking any action. And of course, if we have a mega slide like 37% like we had under COVID, then it would probably tell us that we're in some serious problems. Of course not. Of course not. But this is interesting. Markets like to exaggerate, right? And that's what I'm looking for. So if you remember, in 2021, I said we're going to have rate hikes this year, and nobody was saying we're going to have rate hikes. And then suddenly everybody wants to see a lot of rate hikes. And now that is being pulled back. Now I'm looking for something similar, like a disconnect between what people think and what we're seeing in prices. And if you look at the S&P 500, I don't see that disconnect. I don't see that panic yet. What the S&P is telling us is that this is going to be a small, localized problem. But then on the other hand, you have oil and gold that are telling us that no, this could actually turn into something more worse. So me personally, I'm positioned in gold for now, and I'm gonna try to keep that position for a couple of more weeks until maybe we start to hit maybe $2,000 per ounce.